If you guys have taken a look at it, you will have seen the problems that are assigned to you. In general, if you guys haven't had the previous experience of doing problem sets in Blackboard, I'll tell you some sort of organizational details so that you're not surprised about things. So first of all, you have 5 attempts to do this homework problem set. So if you do it once and you don't like the way it came out, you could do it again. All right? So second of all, there is no time limit. So when you start an attempt, you could just hang out and take your time, take as long as you like. There are 2 buttons in the top right, and also I think in the bottom right. There is the save and get out of here, and there is a save and submit. All right, so when you're just saving it out of here, you can come back and continue working on your ongoing attempt. When you click save and submit, you're submitting it for grading, and that counts as you using your attempt. Right? Okay. So in general, like if you're working and then you need to take a break because, I don't know, your little brother came home and he wants to play or whatever, you can save and get out of here, or whatever that button is called, right? Save and exit maybe. And your whatever answers you put in will be saved, and you can come back later and continue the attempt that you have started, right? So you don't need to use up an attempt until you're ready to say, I've done what I can, let's check my answers, right? Okay, makes sense? If you have taken a look, you will see that the problem sets deal with stuff that we have discussed so far. A lot of them talk about probabilities and binomial distribution and all that good stuff that we have spent all this time on. So, you know, as fun as it was, we had a lot of fun here. I want to actually make sure you guys can now come back and use that knowledge and apply it, right? So that's why we have the problem set out there. Okay? Any questions? All right, good stuff. If you have any, if you're working on this stuff, you have any problems, you want some clarification, you want some hints maybe, feel free to send me an email. All right, and you know, you don't have to suffer in solitude. Or something like that, right? The problem set is there for you to, to practice what we have learned, and so if I can point you in the right direction, if you need a pointer, that's fine. Just kind of send me an email and see. So that problem set is due on Sunday evening, I believe. So you have quite a few days to play around with it and see how it comes out. Has anyone started the problem set yet? Good work. Okay. All right. Let's see. First of all, let's discuss our puzzle of the day. So our previous puzzle was the more socks and drawers. So if you have taken some time to think about it, what do you think is the solution to this problem? Yes.
4 socks.
Why is that?
Because with any 3 picks of 4 socks, you'll get 2 of one color and the other one will have to be another color. So you satisfy both the same color and the separate color.
All right, so that's basically it. Remember last time we solved the problem of what is the minimum number you need to guarantee a pair of the same color, right? And there was a bunch of socks, and we recall that was 3, right? So then now the question is, how many socks do we need to guarantee a pair of different colors, right? So in case we have 2 pairs of socks, it happens to be 3, right? If you get unlucky and the first 2 picks are the same color, the third one is guaranteed to be a different color. So one thing we also have to check is to make sure that this is a unique solution. So what if there are, 5 socks of each color? Then how many socks do we need to guarantee that we get 2 socks of different colors? Right, 6, because we could get unlucky and we could pick all 5 of the same color, so we need the 6th one to guarantee a different color. Right, so the only way we'll have 3 socks to guarantee a different color and to guarantee the same color, a pair of different color and a pair of the same color, is if we have 2 pairs, right? Because that way, we have the, matches both conditions. Right, makes sense? Everybody with us? Okay. So now for today's puzzle, we have a fun, simple one. Maybe simple, I don't know. So give it a look. So are we ready to go? If you're not, you can think about it some more until Thursday. Okay. So our next order of business is, we discussed some stuff about financial plans last time. And in my previous announcement, I posted that I'd like to collect them. So please pass them down. I'll kind of give them a look, and I will try to incorporate some of the things that I see in there in our future discussion in this class. All right? So, there is no bad financial plan. You're not going to get a bad grade for, financial plan if you have an actual, put some thought into it. Right? So mostly it's just for us to inform our future discussion. All right. Okay, do we have everything? We still have people passing them down. All right. All right. Okay. Raise your hand if you are still trying to find your stuff. Okay. All right. Okay. Now let me mention something. At this point, I think we're ready to engage in this exercise here, right? We discussed the idea of expected value and expected value maximization. We discussed the basics of utility theory, right? The concavity of the utility function, and the idea of consumption smoothing being sort of the optimal approach to maximize utility over your lifetime, right? Did that last time. So now I would like to encourage you to give a try to the following game, right? So here is the URL. If you go to this URL, you will find basically an online game. It is sort of like a desktop card game, but it is online. So if you don't have to like actually buy stuff to play this, right? It's like free. And so this game sort of serves as a very, very good sort of parable for allocating resources throughout your life, right? The point of the game is at the end of the game to accumulate the most scoring assets at the end of the game. But the problem is that the scoring assets are basically inert; they just sit there. So if you start accumulating scoring assets very early in the game, they're going to interfere with your ability to produce more assets, right? Because they're just sitting there. So in every turn you draw some amount of cards from your deck, right? And among those cards are certain action cards that let you do stuff. There are money cards that let you buy stuff, and there are scoring assets that just sit there, right? So in earlier stages of the game, you don't want to have, you don't want to draw a bunch of cards and see you have a bunch of scoring assets that won't let you do anything, right? Because the goal of the game is to accumulate more assets, right? Now, so I would like you to sort of to play this game, play several rounds of this game, just to get a feel for it. I mean, first of all, you're going to have to learn the rules, right? So you go to this website. You will see that there is like a help button, and it will kind of tell you the basics of the rules. Play around in the game, see how kind of get a feel for how it works out, right? And play a few rounds. Maybe like playing around in the game on the computer maybe takes like 20 minutes, right? If you play with friends on a tabletop, with the actual game, it can take maybe an hour, right? Because you're hanging out, you're playing with the cards, you have to reshuffle your deck fairly often, right? But when you play against computer players, and the computer should be fairly a lot more condensed version and experience of the gameplay, right? And so I'd like to keep in mind, like you to keep in mind the following questions as you accumulate several rounds of gameplay. By several rounds of gameplay, I mean like once you learn the rules, maybe play like 5 to 10 rounds of the game. And I hope it's actually a fun game. So it won't be like an onerous exercise to do this, right? It's an actual game that people pay money to play for fun, right? Let me just bring it up. Alright, so if you go to this URL, this is what you're going to see, right? So it kind of tells you some stuff about the game, and you can sign up and make an account, but if you don't have to, you can just click the play button, right? And it will create sort of a guest account for you automatically that you basically don't have to worry about, right? And you go in and you can play the game. You can play against computer players, or you guys can actually get together and play a group game with each other, right? There is a multiplayer option that you can go in, you create a table, and you invite your classmates to join your game table and play the game with you, right? Yes?
So they actually have this game on the other side, and they play it at festival, and Mondays, and on Zoom, and
All right, well, there you go. So have you played it? I guess maybe you already know some of the answers to the question. You kind of know what I'm talking about, which is cool, right? Fun game? Okay, there you go. So I guess if anyone has any questions about sort of how things work in certain game strategies or whatever, this gentleman right here is your guy. Okay? Have you played the online version? Okay, so I mean, this actually, like, it's a pretty good version of the game. It is actually made in collaboration with the original game author. So it actually, like, you know, looks and feels exactly like the original, except you don't have to shuffle cards all the time, right? So let me, you know, just show you if they play. Maybe it will work. Okay. All right. Right, so you just hit play, you don't have to sign up, you can basically ignore that stuff unless you kind of want to have an account. You know, you can play single player, it'll create a table with like 3 computer AI players and you, right? Or you can hit multiplayer and you can create sort of a table and, you know, get other people to join you, or you can just find people who want to play multiplayer. They don't have to be your classmates or whatever. And, you know, just kind of play. And so the idea, you know, it's sort of to get you thinking about the parallels between playing this game and playing the game of life, right? In life, you have sort of money and you have productive assets, you know, assets that are actually can be used to produce more useful stuff, right? And then you sort of have, you know, scoring assets, which is, you know, stuff you buy and you consume and it doesn't really help you make more stuff, right? And so, you know, just think about it, play around, and see how it comes out. And probably next week on Tuesday, I'll give you a week to hang out and figure it out and play a few rounds of this game. And we'll discuss how it comes out. Okay? Anyone have any questions? Anyone excited to play the game? Okay. All right. Let me see. So, where's the? Oh yes. So see this question mark here is how to play. It gives you a bunch of information, right? So there is, you know, certain all the areas of the board, and it kind of looks like a lot, but you know, when you kind of look at it and figure it out, it's not so bad, right? There is some basics of the game. You know, there's some funny backstory that is not really not really relevant, and it describes the turns and the cards, and it gives you the game termination conditions, right? Because you have to know when you expect the game to end, so you know how to time your actions, right? And there is, you know, there is some more stuff in there. So if you are of a competitive mindset, there is actually there are actually rankings in the game, sort of like chess rankings. So like as you play and you win rounds, your ranking improves. And you know, if you play with other players whose rank is higher or lower than yours, it has a different impact on your rank if you win or lose. I mean, it's kind of a fun little ecosystem they've built around this Dominion game. So I hope you have fun and learn something. Okay. Okay. Any questions? All right. In that case, we are going to. So yeah, keep these in mind, and maybe some other questions as far as like think about how you would draw a parallel to gameplay versus life play, right? Okay. So now let's talk a little bit about financial statements. At some point in the past, I have requested that you look over Chapter 2 in Gitman, and also look over, I forget which chapter in Edelman that deals with the sort of income statements and budgeting, and draw up your own financial statements, sort of as an exercise of thinking where you stand, what your cash flows are, what your assets are, and things like that, right? So we're going to discuss some of these concepts here today, and maybe in light of this discussion, you will thing of augmenting or changing the financial statement, and if someone later on, I'll let them take it. Right? So, so what is an income statement? You guys right now know what it is because it's read.
It's like a detail of your income and expenses.
Right, so the income statement, right, is a statement of flows of cash that happen over a particular time period, which is your income and expenses. Right? So as you build your income statement, and there are very strong parallels between the financial statements that corporations prepare for their operations and the personal statements that we're going to be working on in this class, right? So if any of you at some point ever want to major in like finance or accounting, this will come in handy. Of course, you don't end up majoring in finance and accounting, so that's fine too. But it's useful information to kind of think about the big picture of where you are financially. A lot of times, people don't even know what's going on. They're taking day by day, they don't know what their expenses are, what their assets are, what they should be doing, and what they should be doing for. It's important to kind of take a few moments and take stock of what's going on, right? So you can take more intelligent decisions as to what you're going to do. So this is the goal behind building these systems, and realize what's going on with my life, right? So in general, what's the first item we have on an income statement? Yeah, basically your income, right? So I mean the basic structure, right? At the top, we'll have our in corporate speak revenue and personal income, right? And so that'll be the money that's flowing in throughout the given period. We can look at a monthly income statement, look at an annual income statement, whatever it is, right? So this is the money that we expect to be receiving throughout the year, right? Usually I'll just say year, nice round time period, right? And a lot of our expenses that we see sporadic on a monthly basis turn out to be regular on a yearly basis, right? For example, if you pay car insurance twice a year, but they this month I don't have car insurance, right? But really, it's a regular annual expense for car insurance, right? So it's generally best to think and easiest to construct your income statement on an annual basis, so you can see what your expenses are, right? But you don't have to. Sometimes you might want to break it down into but it's just a lot more ways to do that. So unless you have a question to do and have a good reason to do that, easier to just think about it, right? So you have your salary, wages, interest income, whatever, anything like that, and that's the money that's coming. Right, so what happens next? Expenses, right? So again, big picture here, of all sorts of expenses. And so expenses you might, for the sake of drawing out your income statement, you might break them up into certain categories to make it easier for you to sort of look and collate all those different items. Because otherwise you have a big, huge list of stuff, and you have to say, well, how am I going to deal with all that? If you break it up into categories, you say how much is in here, etc. And so for a personal statement, probably one of the biggest ongoing expenses would be what? Housing, right? Either you're paying rent, or you're paying a mortgage, or something to that effect, right? Most people's largest expense is on some kind of shelter. Unless you like a full right? So housing. Now, what other expenses do we usually on the first and working stages. Yeah, food is important, even if you're a hobo, you got it, right? Alright, so people generally spend money on food, right? Okay, what other expenses, general expense categories do you ever see? Alright, so I mean that would be sort of a subset, subset of housing, but they do have their own subcategory, right? So unless you're okay, anything else? Alright.
If you have a car, you would be paying car insurance and maybe payments on the car and maintenance and gas.
Alright, so we have, oftentimes we have like a whole category of vehicular expenses, right? So we have, right, and then under that we have, car payments, if you happen to own a car loan, you finance the car, we would have gas, brakes, fluids, insurance, all sorts of things we go, right? Anything else? Right, education. Right, education is another big item for some of us. Right? So I mean, obviously, once you're out of school and working in education expense, right? So there are a lot of these categories of things that you can expect, right? Now, what else do we have after that? And so that's another expense. All types of insurance. Some insurance would belong in the housing category. You have home insurance. Some insurance would belong in the category. You have car. Some insurance is by itself. Health insurance, correct? You have disability insurance. That would be and generally like kind of broken up into where it goes. Okay? Yeah?
The next thing would be money that you spend on things you don't need. And stuff that falls outside of your category.
Alright, so I mean we do have some discretionary expenses, right? So miscellaneous stuff. Right? So certainly this is somewhat in there, right? Now, miscellaneous in general, if you have a lot of these, you might want to break that down into subcategories to see where it is that you're spending your money in this way. Maybe you end up eating out a lot, maybe you end up doing movies a lot, maybe you bought a lot of board games. Or something, right? Or maybe you pay a gym membership, although for you guys, or like so things like that. You don't look at this lump a bunch of money there and say, oh yeah, it's rent. You want to know where it goes, right? Because if you say at some point, it looks like I need to put back on my spending, right? Where do I do that, right? Generally, this is where it will happen. It's pretty hard to put back on your house expenses, right? You have to really show your apartment. Resort, right? You don't want to do that. Or, I don't know, you have to set your thermostat down to 55. It's not going to make a whole lot of difference either. So generally, most of the stuff that you can easily manage, easily change the load off, is right? I mean, there are a number of things you can do within your section important. And that we'll talk more about the building earlier. So try to minimize the you have the compromise the actual right? But this is kind of where the interesting goes after that? And basically, whatever money you make, right? It's sort of like your profit on the income, right? So you made some revenue, right? You had some expenses. Whatever you didn't spend is your profit, right? Your net income, if you want to talk about corporate income, your net income, and whatever money you have left over after you pay all your expenses, right? And so really, ideally, what you're looking to do is to maximize the amount of this residual profit that you have, right? Because profits are cool, right? We all like profits. So, right, so at the end of the day, your revenues minus your expenses is going to be your net income, aka profit, right? So where does this profit go? So ideally, you would take this residual money and invest it for future consumption, right? You're trying to build your asset base, right? Because maybe your eventual goal is to have sufficient assets so that you can live on investment income and not have to do anything in particular to generate salary, right? It doesn't have to be your goal. You don't have to quit working as soon as you accumulate sufficient capital. But as we discussed, one of the biggest sources of sort of happiness is freedom to do what you want, regardless of what it is that you want, right? And one of the most effective ways to have freedom to do what you want is that no matter what happens, you have your job, whatever, that you have a source of income that you can rely on, you can fall back on, no matter what happens, right? So ideally, when you're just starting the game, right, you don't have very many assets, right? You have some productive assets, namely your ability to be productive for others, produce some kind of salary and wages, right? But you want to acquire more productive assets over time, right? So that those assets will work for you. If you basically spend whatever you are making and your productive years, right, but I have all this residual income, what am I going to do with it? I'll just buy some more stuff in the miscellaneous category, right? The thing is, you have to realize that you're not necessarily always going to be able to be productive in such a way that somebody will be willing to pay for it, right? Or at some point you just want to retire, right? So your goal is to build up the financial cushion so that, and the sooner you can do that, the better, right? Because then it's kind of snowball effect. Once you have self-sustaining base of assets, you just keep growing and growing. And the next thing we'll talk about after we talk about financial statements, is we'll talk about this idea of investment returns and compound interest and future values and all that kind of stuff, right? And we'll discuss how it is really very important to have the longest amount of time that to accumulate investment returns, right? The amount of time you have an investment is really a crucial component to your final wealth, right? And we'll discuss that after we're done here. So maybe but in general, right? That's the idea, right? So, in order to sort of fool ourselves a little bit, oftentimes you will see investments go somewhere in the expenses. Because they know I have to invest my money, I'll put it in my expenses here. So I know that I'm anticipating to invest $500 a month. So I'll put an expense of $500, right? So, and in fact, you put it here before your discretionary stuff, right? And so you say, whatever is left over after I have invested what I wanted to invest in my asset base, then I'll start doing my discretionary spending, right? You don't want your priority to be discretionary spending today at the expense of your investment community, right? But this is kind of just a little mind trick that you play of yourself at the end of the day, right? It doesn't really matter which word it goes, right? But you really want to think, what are my investment goals? If you have the spare income to actually invest. Hopefully, if you do it right now, because maybe you're in school, you're working a part-time job, etc., it's fine, right? But as soon as you can start accumulating the base of wealth, you should start doing that. Any questions? Anything somebody wants to add or? All right. Right. So this is the basic flow of the income statement. Now let's talk about the balance sheet. What is the balance sheet? I'm sure you all have.
It's like assets, plus capital on one side, and then liabilities on the other, and then
All right, so again, so the reason that it's called the balance sheet is because the two sides of it have to balance, right? And they balance by construction. So canonically speaking, the balance sheet, we have assets on the left, right? And on the right, we have liabilities and we have equity for in-person financing, right? So what goes under your assets? What is like the broad categories of assets that you can have? Yes. All right, so we have basically short-term liquid assets, let's call them. In corporate finance, current assets. So these are assets that are convertible to cash. You don't have to, if you ever see it. Yeah, what else? Well, is cash liquid? So it's already, right? But yes, it's important to think what kind of assets are liquid assets. Cash is one of them, right? So it's fine. Anything else? Yeah? All right, so what category of assets would have generally been? As an example of an asset, if you have it, great.
Personal property.
Maybe, right? I mean, in general, yes.
Real property?
All right, so again, for personal finance peak, we have certain different categories that we don't see in corporate speak. Probably personal property, that is mentioned. I wouldn't put large long-term fixed assets, right? Personal property is just like random stuff you have, right? So and we have a separate category for things like long-term large fixed assets. Maybe I would call it like long-term assets or fixed assets or something like that, right? And here is where we have the house, right? And here where we have the car and whatever other big property you might have, right? Now, well, let's say you have some investments, like some stocks. Where would that go? Generally, investments tend to be pretty liquid, right? Unless you have something that's not easily available. You buy some stock, it's very easy to just go and sell it and get cash for it, right? So it tends to be pretty liquid. So you might say maybe they'll go into my liquid assets, and maybe they will. But it sort of depends on what kind of mix of investment you have, and if you actually have any. If you have a diversified mix of investment, you would in fact have a separate category for like investment assets, right? And so maybe you'll have those kinds of categories here, right? Maybe investment assets. And that'll be basically all the stuff that you own, and you have an ownership stake in, right? Now, how do we finance these assets? Well, that happens on the right side, right? In order to get an asset, we could either just use our own money for it, or we can borrow money for it, right? So in general, we have liabilities, which is a big piece over here, or we have equity slash net worth over here, right? So for example, let's say we have a house, and that house has a mortgage on it, right? So that means that we finance the acquisition of this asset in part with liability, which is debt, right? So part of our liability here is going to be mortgage. Now in general, we separate the liability into long-term liabilities and current liability. Current liability is also known as short-term liability, right? So maybe your monthly credit card bill is a short-term liability, right? You don't know when you get it in the month. You don't have to be paying this for a year. Whereas something like a mortgage is a multi-year liability. And so that's a long-term loan. And maybe your car loan will be a multi-year liability. Maybe your student loan will also be a multi-year liability, right? So, in essence, generally speaking, right, what we have is that net worth or equity is whatever is left after we pay all of our assets and subtract all of our liabilities, right? So in other words, you can imagine that, what if I had to pay off all of my liabilities? How much would I have left over? Well, I'm going to sell off all my stuff, use the cash to pay off the liability, and whatever cash is left is my net worth. Right? So what's our goal as far as we're looking at our balance sheet? To increase our net worth over time, right? We're going to have more wealth, right? Your total assets is not the measure of your wealth, right? Because a lot of the stuff could be financed with debt, right? Your the measure of your wealth is your net worth. How much do you have net of all your liabilities? Right? So just because you have a huge ass $2 million house doesn't mean that you have a lot of assets if you have a $1.8 million mortgage to go with it, right? Or just because you have like a fancy ass Hummer that costs you $50,000 doesn't mean you have a lot of assets if you have, I don't know, $45,000 car loan to go with it, right? So what matters is how much you have on top of your liabilities. And as we start out, it is often the case that we end up having a lot of liabilities to deal with, right? So we have our mortgages. As students, a lot of us have student loans that kind of accumulate pretty heftily, right? We might have car payments. We might have, finance the purchase of, I don't know, like if you really bought a house and you bought some, like a washer and a dryer, maybe you finance the purchase of the dryer. You tend to have some, a certain hefty amount of liabilities. And there's nothing wrong with having some liabilities, right? As we discussed last time, if you can manage to get a loan at a really low interest rate, it's actually beneficial to you to have the loan rather than not have the loan, right? Because if you get the loan, that means all the cash that you didn't spend, you can now invest and get an even higher rate of return than the interest you're paying on the loan, which in the net is a win for you, right? Unfortunately, it is not always, there are only a certain limited number of classes of loans that you can get at a really low interest rate. Most of the time, you get the loan from somewhere, and they're going to basically really on the interest rate, right? So if you have loans that are charging you like 10% or 15% per year in interest, this is not the type of loan that you want to have, right? Because the money that you save by not paying your own cash is not going to be able to generate a return that is high enough to compensate for interest. So it's a net loss for you to put money in, say, an equity portfolio, at the expense of having borrowed it at 15% per year. Because, historically, diversified equity portfolio doesn't return 15% a year on average, right? Maybe returns 8 to 10%. So you know that on average you're losing 5% per year if that's the trade-off that you make. Right? Yes.
So the other day you said it wouldn't make sense to make an additional payment on a mortgage or something like that because you would have the ability to reinvest your money, your extra money, with a higher rate of interest.
Right.
If I have a 10 or 15% interest rate on my loan and I can't earn a higher,
then you would want to make an
then
extra
it makes
payment
sense
on
to do
it.
that.
That's right. Right? So I'm glad you brought it up. Just to be clear, the mortgage makes sense to delay payment on because it has an interest rate that is lower than what you can generate in general diversified investment. Right? But you wouldn't want to do the same thing if you have a loan that has a UV interest rate. Because it'll be more than what you can make with the money otherwise. Right? So think of it, when you repay the loan, it's like you are getting the return of the interest rate that you would have paid, right? So when you repay a loan that was charging you 15%, it is equivalent to investing in an investment that returns 15%, right? Because you just saved 15% worth of interest expense, right? And so you say, hey, that sounds like a good investment. I'm basically earning 15% of my money if I repay a loan that charges me 15%. Now, when you repay a mortgage, you're saying that's like an investment that pays me 3%. Right? So if you have other better things to do with your money, why would you do that, right? Instead of investing in repaying your mortgage and earning, in effect, 3% rate of return, maybe you would rather take that money and invest in something that has a higher expected rate of return. Right? Make sense? Everybody buying that? Anybody have any questions? And do you understand why repaying a loan is equivalent to getting an investment return of that amount? Right? Because you are avoiding an expense of that money, right? And avoiding an expense is like getting money, right? In fact, as we discussed, saving $1 nets you $1, whereas getting extra money nets you right? So, right. So that's basically our goal is to increase this net worth, right? Hopefully, a lot of your net worth is going to be actually generating a return and just growing by itself over time, right? If you have all your net worth in a mattress in your bedroom in the form of greenbacks stuff in your mattress. Right? That's not an investment that is generating a return for you, right? So what's happening with the purchasing power of your cash in the mattress over time? Right? It's actually decreasing because of inflation, right? As we discussed, if inflation is about 2% per year, that means the level of prices as denominated in dollars, generally the economy is going up at 3% per year. So it means that your $1,000 would buy you some amount of stuff today. In a year, it would buy you only what $970 would have bought you a year ago, right? So every year you lose 2 to 3% of purchasing power on the money that you have just sitting there in the form of cash. Right? And that includes bank accounts, and that includes cash in your mattress, right? And that includes bank CDs, and basically anything that is denominated in dollars is losing purchasing power just sitting there, right? So you have to run just to stay in one place. If you, right? Right? Okay. I want you to, so for next time, I want you to sort of review your financial statements, right, the income statement, the balance sheet, and see what if you have things categorized, see what are your, what are your income and expenses, see what kind of inferences you can draw from income or income statement. Are you spending too much money? Are you investing enough in your long-term investment assets, right? Give it another once over, and maybe next time I will select them to take a look. Now, another important piece of financial planning tool set is the budget. Look at that, it's the budget, right? So what is a budget? How is it different from an income statement?
Budget is, you plan how you're going to spend your money.
Right, so an income statement is essentially backward looking. It's like what happened. Right, a budget is forward looking. So what do I anticipate will happen in the future? Right? So of course the idea of planning is planning for the future, right? So an income statement is a tool to let us know where we have been, how we have been spending our resources. A budget is how do we plan to spend our resources? What can we do in order to improve our position at the end of the game of life, right? Which hopefully is not. For those of you who have read the Edelman chapter on budgeting and how to get out of debt and all that stuff, right? That's kind of a big chapter. What are the two major methods to construct a budget? Estimate your expenses.
If we check on your liabilities, how much you owe to each creditor, and sort by interest rate?
Well, I mean, that's what you do if you have a bunch of liabilities and you're thinking, which one do I pay off first, right? And we discussed that. You want to pay off first the one with the highest rate, right? Because it gives you the biggest bang per buck, right? Now, what I was actually, which is an important point, right? But what I was actually aiming at is, and you might recall, he said, there's one way you can do that is to sit down and to go through your historical spending and income, figure out what your level of income and expenses will generally be and what you can anticipate in the future. And that'll take time. Another way is to say, I'm not going to sit there and try to go through all my receipts and bank statements and things like that. Just starting from today, I'm going to record what happens over the next few months as it happens, and then I'll magically, at the end of a few months, I will have collected a bunch of data, right? In the context of this course, we don't really have the luxury to do that for 6 months to see what happens, right? So I would hope you would have spent some time and actually look at the past several months of your income and expenses to see what kind of things you need to budget for in the future, right? In general, right, the income statement is very closely related to the budget. But you want to plan for what happens in the future, and maybe you want to you're expecting some new expenses to happen in the future, or maybe you would be looking to try to reduce your expenses in the future. It's really a good tool to track whether you can keep to your plan or not, right? Because for one thing, a lot of things happen that are not really planned, but they happen on a regular basis. Right? So maybe you do not really plan, mostly we're talking about stuff breaking. Right? You do not really plan to have to go to the car mechanic and replace your battery. Right? But if your battery goes bad, you gotta shell out $100, right? You don't really plan to have to fix your dryer, even if you happen to have a house and you have a dryer, right? But dryer breaks, and you're thinking, well, do I pay $300 for a guy to come out and fix my dryer, or do I pay $400 and get a new dryer? Probably you should get a new dryer. All right, so it's there are things happen, even though you don't. Any individual event may be unusual and very rare, right? Like a car battery, it lasts 6 years or 7 years. You don't have to replace battery every time. Your washer and dryer maybe lasts, I don't know, 5 to 10 years, depending on how good it is. You know, your computer lasts 5 years at least, right? Or things generally last for a while, like as far as our personal property goes. But because each of them has a certain probability of breaking and requiring maintenance on a regular basis, what ends up happening is that you have a regular flow of unexpected expenses. So in the aggregate, they actually become expected, right? But if you don't, I mean, that's one category of expenses that people tend to underappreciate. They don't think, I'm planning to spend $100 on unexpected expenses, or something like that, right? I mean, that's the reason they're called unexpected. But if you look at your spending patterns over time, you will see that on a regular basis, there is like something pops up you have to do, something else pops up you have to do, right? So you don't really, you don't want to ignore that and say, hey, it looks great. I have $500 a month extra that I'm planning to invest every month, right? And so it's pretty cool, right? But if every month something comes up, and instead of having 500, you have only 200 left, then that throws a wrench into your financial plan, right? It happens every month. You're saving a lot less than you want, right? So that's why you need to take a look at your actual pattern of spending, your actual pattern of expenses, so you can incorporate it into your future budgetary planning. So you can say, okay, if something on average is going to happen every couple of months, it's going to eat into my monthly profits. And if I want to invest $500 a month, maybe I need to adjust some of these other expenses, right? Because I have this unanticipated but regularly happening other expense that is hard to plan for. But if you look on average, right? Make sense? Good stuff. So, have you guys actually built income statement, balance sheet, and some kind of a budget plan so far? No? That's fine. I asked you to do that. It's fine if you didn't. And I appreciate your honesty. Yes? That's,
Like, most of these things I do, like,
I mean, that's just fine, right? I mean, this is sort of an average for basically for people who are economics, right?
yeah,
So-
that's why I think just like, I like to do that.
Yeah, I mean, that's fine. I mean, for a lot of you, these income statement and balance sheet are going to be a lot simpler than what the example in the book tell you, right? A lot of the categories you might not even have, right? But in the future, a few years down the road, some of these things are going to start to pop up. So it's fine if you don't have them now, just put in a zero and move along, right? But keep in mind that at some point in the future, financial planning process is not something you just do once and never do it again. It's something you have to revisit on a regular basis. And regular basis doesn't mean you have to look at it like every month. We all have stuff to do, right? But at least, if you spend some time, every 6 months or every year, just to see what you have been doing, like how your expenses are, what are your investments doing, and all that kind of stuff. And so if you just get just get a feel for how it works, right? It's fine if you don't have this stuff, right? Make sense? And if it's looking a little bare, that's okay. I mean, I know when I was younger, it was a pretty much a blank table, right? With nothing happening. And I wasn't a student of finance at the time either, so I didn't even do this kind of stuff. You guys should have a leg up on the people who don't get to think about this stuff until it's too late, right? So hopefully this course and these ideas and these tools will pay you a lot of dividends for your future success in life. Okay, so for next time, please review these if you have done, you have drawn up a sketch of your financial statements, or make them if you have not, and it's fine if you haven't. Just take a look at it and think. Some of them might be you might be missing a lot of the categories. That's fine, but just see where you are and think, where do you expect to be? Right? How are you going to get there? Right? Okay. So now I would like to discuss the basic ideas of taxation in the United States. Right, now, you don't need to know the exact tax brackets and the tax percentages and all the little different rules and all that stuff. Right? For one, that stuff changes all the time. Right? There's no need to memorize it or details or anything like that. Right? I really want you to kind of understand the basic ideas, right? The flows, the workflow that goes into it, the different kinds of taxes, etc., just so you have an idea of what's going on in general, right? But at the end of the day, I'm not going to say, oh, prepare your tax return for 2040 or anything like that, right? Because just mostly just a bunch of busy work, and I want you to just kind of understand how things work. And at the end of the day, I will tell you that unless you just have like no taxable income, or something completely ridiculously simple, it pays to just pay $100 to a CPA and have to do it, right? There are so many different rules, there are so many different deductions you can make that you haven't thought of, so many things that if you do it on your own, number one, it'll take a lot of your time. And time is money, right? You could be spending the time doing something more useful, right? And number two, you could be missing a lot of deductions you have, or you could be deducting something you shouldn't and inviting an audit. And audits are, again, expensive time-wise, right? So really, it is not a bad idea to just pay $100 or $150 or whatever the going rate is these days. Actually about $150, and just give the guy all your stuff and say, here's my stuff. Do my taxes. Here's $100. All right. So I'm not going to. That's what I do, right? I'm not going to spend my time figuring out 1,000 pages worth of tax code. I didn't do all that. It's not worth my time. I have guys who are professional, they specialize in it. They charge a very reasonable rate. So I'm going to pay $100 and save a bunch of my time, right? And reduce a lot of my risk as far as my improper preparation, foregone deductions, or etc. Right? So let's learn about how in general things work. So then when we talk about tax rate, and we talk about marginal tax rates, you will know what's going on, right? So how many of you have read Chapter 3 in Gitman about taxation? Okay. How many of you have not read Chapter 3? How many of you have not raised your hand on either one of these questions? Okay. So I'll assume the guys who didn't raise their hand on either one haven't read, right? Probably a safe assumption. So that's fine, again, when I say read something and I don't give you an assignment to do something with it, like for example, I ask you to read Chapter 2 and draw up your financial statements, I would like you to actually spend some time reading it. But just say, hey, read this chapter, and it means give it a skim. You don't have to spend 2 hours digging into the details. Give it a skim so you know what we're talking about in class, right? So, just please at least do yourself this favor, right? Give it a little skim if I ask you to read something, right? Okay, so in general, what happens is that tax laws in the United States, in general, they're very complex. They're probably more complex than they have to be, but as any law, there are outgrowths of a bunch of politicians who really compromising and mine out of what your back if you look mine, right? There's a lot of trust that has accumulated in the tax rate. But the general principle is this, right? You start with your gross income, which is like how much money you have made in the course of a year, right? And then you're going to deduct certain adjustments to your gross income. So those adjustments are going to reduce your taxable income, right? So you don't get taxed on the whole gross income. You get to subtract certain things from that before you start to pay tax. Just pretty good, right? It's pretty nice. So if you can have more of these deductions, it's a good idea, right? Then you don't have to pay so much tax. So one of the most common deductions in this category is your investment in the IRA, which is an individual retirement account, or some classes of that, employer-sponsored accounts called 401k. So these are like retirement savings accounts where you can put money before you pay tax on it. Right? And we'll talk some more about IRAs when we deal with more details of retirement planning, right? But in general, it's a good idea, right? Because you take your gross income, let's say you made $100,000, to make it nice and round number, right? And let's say, if you didn't deduct anything, you would be paying tax on the basis of $100,000. But instead, what a traditional IRA allows you to do is to say, hey, I'm going to put $10,000 into my retirement account. So what happens is if you take the $10,000, you put it in, and you don't have to pay taxes on that $10,000. It sits there in your IRA for decades and decades and decades. You can invest it in anything you want, like equities, bonds, whatever you want, right? It's just like any other investment account, but it has a special designation that says this is my IRA, right? And it grows, and every year you make an investment return there, you don't pay tax on it. And it depreciates tax-free, and you only have to pay tax when, at the end of, after a few decades, when you retire, you decide to take some money out, that's when you pay some tax. So it's a really attractive investment vehicle, right? It's a really useful way to increase your savings for retirement. And because, as we'll talk shortly about compound interest, and we'll draw some examples out of that, it really increases your earnings if you don't have to take something out every year to pay the tax on your earnings, right? Because it grows tax-free and compounds every year. So we'll discuss more about different types of IRAs later on, but so we have some adjustments, right? And then we have your adjusted gross income. And we get to deduct some more stuff. Right? So in general, you have a choice between like a standard deduction, which like if you're a single employed person, the standard deduction is like $5,000. Or you can do itemized deductions. And itemized deductions, you can basically there are certain things that you can, if you decide to have a detailed itemized schedule of deductions, you can deduct certain classes of expenses. For example, mortgage interest is the most common deductible expense, right? So if you're paying a mortgage, in general, you will have a lot of mortgage interest, especially in the beginning, as we'll talk about loan amortization later as well, right? And so, as a result, your itemized deductions, if you're paying a mortgage, would likely be bigger than your standard deduction, right? And there are certain other classes of expenses as well. If you have medical expenses totaling more than a certain percentage of your income, they can be deducted as well, right? There are a lot of laws about what kind of things can be deducted, and that's where your CPA comes in handy, right? To figure that stuff out. So if it's so you can choose whether you want to do the itemized deduction or the standard one. So if it turns out that your itemized deduction, is say $7,000, and your standard deduction is $5,000, which one are you going to take? Yeah, you're going to take the bigger one, because of course, if you can make a bigger deduction, you'll pay less taxes. Right? So if you can reduce your tax burden, you're going to do. So it's nice, like you have a choice which one to do. So depending on if you have a lot of expenses in certain deductible classes, it makes sense to do the itemized one versus the standard. In general, like as a student, without a mortgage and without large medical expenses and without certain other, it probably is more advantageous to take the standard deduction of $5,000 and move along, right? So then we have personal exemptions. You see, there's more stuff. Right? So if you're like a single person, the first household of one guy, you get a personal exemption of about $3,000. Right? So you get to subtract another $3,000 from your investment. I mean, if you have dependents, you get to subtract about $3,000 per person in your household. Right? So like if you have like 2 kids, right, and a wife, right, you can you have a 4-person household, you get to subtract 4 personal exemptions, right, or something like that, right? So in essence, I would assume most of us here are just have our households of one, although possibly I think until the age of like 23 or so. You can be claimed as a dependent on your parents' tax return, so probably that's what a lot of you are doing, right? Because if your parents' tax rate is higher than yours, it makes sense to deduct the personal exemption from somebody who has a higher tax rate, so you save more on taxes, right? And at the end of that, we have taxable income. So that is the subset of your total income that we're going to pay tax on, right? So far, so good. So far, it's all good stuff. It's like saying, hey, we don't have to pay taxes on that, and we don't even have to pay taxes on that. We can subtract a bunch of stuff. So we pay taxes on the smaller subset of our total income. Now, once we get that, we move on to the actual tax rate schedule. So. Now these are roughly the tax brackets for 2013 for federal tax. So again, as it happens, the tax is not just to say, oh, you have so much, this is how much money you made, oh, you pay 10% tax, or you pay 20% tax. Either, your income is broken up into brackets. So what happens is that you pay 10% tax on the first 9,000 of your taxable income. Or so. It's not. These are not exact numbers. I rounded them to the nearest thousand, right? So on the first 9,000, you pay 10%. Then on the next 9 to 36,000, the next 27,000 of your income, your taxable income, you pay 15%. Then on the next chunk of your income, you pay 25. And on the next chunk, you pay 28. And on the next chunk, you pay 33. And there are a couple other chunks that are probably not very relevant. Right? So when you say, I want to calculate what is the total amount of federal tax that I owe on my taxable income of $100,000, for example, right? One more minute. Okay. We'll probably start with the beginning of next time, right? Right. So you can see that there's a lot of detail that go into this, right? And I haven't even dug into the actual details of what kinds of things are deductible. But we'll go through an example just so you get a feeling for what's going on. And we'll talk about the important difference between marginal and average tax rates. And after that, probably we'll go into discussing investment returns and compound interest and things like that. All right, so for next time, remember you have your homework on Blackboard that's due on Sunday. And please look over your financial statements, and I'll collect them on Thursday. And I will see you.